Hello, everyone. Guy Adami here with my dear friend Dan Nathan. It's Tuesday, January 12th. We took last week off. We're back now for the macro setup brought to you by our presenting sponsor, Nadex, the leading U.S. exchange for binary options, call spreads, and I'll spare Dan this time, and knockouts as well. Lots taken place over the last couple of weeks. I mean, so much to talk about here, Dan, in terms of valuations, risk, what's going on politically. But yet here we are on Tuesday the 12th, and the S&P seems to be exactly where we were when we did our last macro setup. It's fascinating that the market seems to look past everything. Love to hear your takes.
Great to be back with all the folks from Nadex here. Interesting, like you said, Guy, the calendar turned, the news flow kind of came in hot and heavy the same way it had been right up until the end of the year. And like you said, the S&P 500 really barely blinked. We saw some quick profit taking on the first trading day of the year, but since then kind of making it back in some of those kind of speculation pockets that we've been talking about on the macro setup over the last few months have really kicked into full gear in a way, and so I guess it's just really interesting when you think about, we had been kind of targeting the election, and then what does the Congress look like, right? And what does that mean for a whole host of other things going forward? And then we had the Senate runoff, which was obviously a big thing. So all of that came to pass. There was obviously what happened in the Capitol last weekend, and the markets didn't blink. I mean, how do you kind of diffuse all of that, Guy? What are investors, why are they not concerned about some of this headline risk?
It's amazing. We talked about it on Fast Money, and if you'd told me on the night before all the things were going to transpire, I guess I was that Wednesday at the Capitol, and you had said, Guy, where's the market? Anywhere from 800 to 1,000 points. The dollar's going to get whacked. The gold's going to go higher. The VIX is going to be either side of 30. And maybe you see a flight to quality in the form of bond yields. And every one of those things would have been wrong. It's incredible. And I find myself shocked all the time. And I think that day for me was one of the most shocking days in terms of the market reaction. And how do you identify it? How do you explain it? I think it comes down to one word, the Federal Reserve. And that's more than one word, I know, but you understand what I'm saying. I think the market has this belief that the Fed has their back, and there's going to be this, more stimulus, more money put into the system, and all this leads back to the equity market. I think that's short-sighted. I think that's misguided. But right now, the market seems to think that's the right way to look at things. And we're going to talk about euphoria, Dan, but that's my view on what's been going on over the last couple of weeks.
Yeah, I think to your point, it really does come back to what the Fed has been indicating for the better part of 2020, right? Obviously, since the pandemic was the main story, that chart right there of Citi's euphoria panic index just shows you that their readings and the inputs that they tabulate that reading for are just off the charts here, right? And so it is different this time. The Fed's been telling us that they are going to let inflation run hot. They're not going to raise rates for a couple years. They're going to continue to buy all sorts of assets, MBS, mortgage-backed securities, 40 billion a month, that sort of thing. So, at the end of the day, they're trying to keep monetary policy as easy as possible, and they're willing to let asset bubbles kind of bubble up. I guess the only issue is that we know that in the last, 20 years or so, when that has been the case, that the bubble keeps, kind of getting bigger and bigger and bigger, but ultimately it does burst, and it does leave some destruction in its wake here. So, we can move on from that. I mean, I just don't even know what else to say about
but quickly,
that.
I just want to say, just quickly stay on this chart for a second. I know we want to move on, but you look at this and we talk to people and we ask them if there's any similarities between now and 2000. A lot of people say, no, they're not. You know what? They're right. It's actually worse now when you look at this chart and you go back, that peak was in 2000. And now you look at this panic euphoria index, and we're considerably through what we saw in 2000. And that speaks to a lot of different things. Hubris is one of those things. Complacency is another one of those things. But you're right, folks. It isn't like 2000. In terms of this specific chart, it's a lot worse. And we can move on from there. But I think it's worth pointing out, Dan.
Yeah, what's interesting, though, about the comparison to 2000 was that, the asset bubble was in public equities. I mean, there wasn't this huge amount of capital that was sitting on pension sheets, balance sheets that were in, private tech companies, that sort of thing. And I guess exhibit A for this, is the speculation that is caused by the euphoria is the Bitcoin, and we had our good friend Brian Kelly who runs a digital asset firm, on the macro setup maybe a month and a half ago, when this thing was just kind of going parabolic. But I don't think anyone thought that would do what it did in just the last month. And, we have a 1-year chart of this thing. When you look at this, and when it broke out above 10,000 just back in October, then it doubled to 20,000. That was the prior all-time high from December 2017, January 2018. We know what happened after that. It went from 20,000 down to, I think at its lows, maybe 3,000. So, this base had been building for the better part of 2020, and then it just kind of went ballistic. I think it was high as 42,000 the other day, traded as low as 30,000, from 42,000 to 30,000, a 24-hour period. It's since come back a little bit, but we have this 5-year log chart of Bitcoin. And this is the one that we kind of highlighted on a couple of occasions prior to that breakout. That's what a lot of speculators were looking at, a long-term breakout, 20,000 becoming the new support on the way down. And I think a lot of people who believe the fact, all the things that you have said about the Fed and why you want to own gold for a store of value as a certain percentage of your portfolio, I think that the switch flipped a little bit here. And a lot of those people that normally go into gold, we're going to hit the gold chart later, are kind of in the Bitcoin institutional adoption. Their ability to hold these digital assets now has changed the game here. So I'm just saying to you, if you see this thing back towards 20,000, that's where a lot of people are going to step in. But don't forget that 2019 high is down there at 14,000. The volatility of this asset is the thing that attracts a lot of people. But for the last year, they've only seen it gone one way.
Yeah, and it's what's going to be unfortunate here, I think, and I could be 100% wrong, I think is the fact that move from maybe 28,000 to 42,000 probably dragged a lot of latecomers in that, quite frankly, shouldn't be in this asset class. And that move from 42,000-ish down to 30,000 was abrupt. It was scary. And to think that it can't happen from this 33,000 level back to 20 is probably misguided. And, typically the ends of moves tend to bring in sometimes the weakest hands. And I think to a certain extent, that's what you're seeing now. I think you have to have a plan for Bitcoin. I think the plan should be, if you haven't gotten in, wait for the move. In my opinion, the inevitable move back to 20,000, where we take a look back at that December 2017 high, and obviously the level that we broke out from. I think that's the prudent thing to do. And if you miss it, it's one of those things, you just say you missed it and you move on. But if you're looking for this for a trade, that's the way I would be trading it right now, Dan.
Yeah, so you talk about, kind of some of these latecomers to a mania, and that's really what we have here in a couple of different risk assets here. Let's go to Tesla. This is one that we also have talked about over the last couple of months here. This is just a 1-year chart. You see at its lows in March, this thing had a sub $70 billion market cap, and now it's up, I think it's $600-700 billion. It's greater than all of the publicly traded auto companies the world over combined. It has a bigger market cap than all of them. It has about 1% of global auto market share. And when you look at that, where the stock really started going parabolic in mid-November, that's when the S&P 500 said it was adding it to the index. It went in the index about a month later in December 18th, and the stock has gone from 400, it's up over 100%. That's a mania. I mean, there's no other way to describe it. Elon Musk may be the most genius person who's ever stepped foot on this planet. And I say that like that because I think some people on this call believe that he might not be from this planet. Guy, I'm not sure if you want to go there right now, but this is a mania, and it's being driven by, I think, retail to a great degree. I don't think institutions are getting in there buying it. And that's, to your point, coming late to this sort of thing. This reminds me most of 2000. It also reminds me, when you think about who's buying this stock, it's the Robinhood traders. These are people that, hey, all the power to them if they're getting rich buying all this stuff. But going back to 2000, when the E-Trade was the thing, when online brokerage was just really proliferating, armies of day traders were fueling a lot of these gains, and stocks being where they shouldn't have been. I'd love to get your take on this one in particular, and what it means about these kind of latecomers, and then let's move to valuations, because that's a really important point too.
Well, I've said it for a while, and people say, how can you opine on Tesla, the stock, if you don't understand the company? And I can understand that point of view, but I just what we're trying to do on our show Fast Money and on this is try to give you levels and ideas to trade around. And I've said it for a while. I'll say it again. I don't necessarily completely understand Tesla, but I do think I understand the stock. And I said it a couple different things over the last year and a half. And the first thing quickly was the Joe Kernan interview with President Trump from Davos almost a year ago, when Joe Kernan asked the president, what he thought about Elon Musk. And I'm paraphrasing, but President Trump said something effective: "We did right by him when his company's in trouble, and now he's going to do right by us." And I encourage you to go back and look at that interview. That to me was alarming and startling. And quite frankly, since that interview, with the exception of the move in March, stock has never looked back. And then quickly in May of 2020, when the stock made an all-time high of 703, Elon Musk tweeted out that the stock was overvalued or too rich or something to that extent. The sell-off lasted for a day. And those 2 points sort of led me to believe that this stock is impervious. And I still believe that, by the way. And it's being fueled by a lot of people who just have seen the stock go nothing but higher and somehow believe this company such. So we'll see what happens. There's going to be a day, and I think you agree with this, Dan, where Tesla could be down 15 to 20% in one day. I don't think that's out of the realm of possibility. I can't speak to the implied volatility of the options, but I think if you're in the name, you have to prepare yourself for that. And by almost extension, the broader market as well, Dan.
Yeah, I listen, we highlight Tesla because neither one of us have any kind of axe to grind one way or another. But when you see a company go from 70 billion to 700 billion in a matter of 10 months, and the fundamental story has not really changed a whole heck of a lot. And I focus on the fact that in November 16th, prior to the S&P 500 announcement, the stock was down 20% from its September 2nd all-time high. It looked like it was actually going to break down a bit. So obviously institutions got in there and started buying in front of the ad, then shorts started to cover, then the day traders piled in, right? It was a good old-fashioned short squeeze here. But what's going on, if you just look at that breakout above the prior high this year, which was 695 on the day of the ad, that is retail, in my opinion. That is not institution. So buyer beware right there. And we just show that really, that kind of big uptrend there. So, to me, that just, again, we highlight this Bitcoin and Tesla as just an expression of the kind of euphoric sentiment that we think exists for risk assets, and largely at the feet of the Fed allowing these risk asset bubbles to kind of move on. Let's talk valuations here. We have 2 metrics that are very popular for a lot of investors to quote. This is the PE of the S&P 500, the price to earnings, trading at about 22 times forward. That is well above the 17 and a half times of the last 5 years and about 15 and a half of the last 10. So you think forward valuations are getting stretched here. We know that Facebook, Microsoft, Apple, Google, and Amazon, we call that FMAGA. Throw the T for Tesla on there at the end. You got FMAGA. And, that makes up what? 15% of the S&P 500. And we know those valuations are getting stretched. What's your take on valuation? And does valuation matter?
Well, I do think valuations matter. I've always thought the stocks are built on 4 basically pillars, 4 corners. It's revenue growth, earnings, and earnings growth. And there's no way to get around that. Yeah, there are times in history where the market has looked past that, but it always comes back to those 4 things. Now, your question is, do valuations matter? Well, I do think they do, but apparently Jerome Powell doesn't think they do, because about a month ago, he said such that in the world of basically free money, valuations really don't matter. Again, I'm paraphrasing, but I encourage you to go back and look and see what he said, because I found it fascinating that he would make that comment. And right now, the market doesn't think valuations matter. So again, we talked about the levels we saw in 2000 in terms of euphoria index. Well, we're getting precariously close to that in terms of valuations. And, there's going to come a day when the market wakes up and say, despite the fact that the Fed is there, valuations are ridiculous at these levels. And I think we're right at those. We're precariously close. So we're going to see what happens. There are a lot of people that think 2021, the market gets a mulligan. I'm not one of those people. And there are people that think in the back half of this year, there's going to be this reacceleration. I'm not one of those people. But that's what makes markets, Dan. But just to illustrate and to bring this up, and then you can go back and look at that euphoria panic index. I mean, both of those things are absolutely flashing red. And let me add one more thing before we go to our next slide. GDP over market cap. So right now, the market cap of the S&P 500 is about 190 or so % of GDP. And I'll say again, the numerator keeps getting higher, and the denominator, in my opinion, it's not going higher, and if anything, it's going lower. So that is also flashing red, my opinion, Dan. So anyway, we'll move on to the next slide, but I just wanted to bring those points up.
Yeah, I think price to sales is an interesting one. We know that earnings can be manipulated by a whole host of other things. They're obviously very affected by interest rates, the ability for companies to kind of borrow and buy back their stock. So, PE is not one that I think a lot of very sophisticated investors spend a lot of time thinking about, but price to sales is one. And when you see this just kind of ramp in the S&P 500 price to sales ratio, a lot of that has to do with the fact that the biggest names in the S&P 500, they won the pandemic. These are companies that have $200 billion in sales. You know who they are. It's Apple, it's Amazon. Then the ones with $100 billion in sales are nearing, Facebook is getting up there, Google, obviously. So Microsoft is up there too. So, that metric is just kind of off the charts. And I'll just make one other point. Guy and I get a lot of tweets. We get a lot of emails from viewers of Fast Money or programs like this, and we try to respond to a lot of them, especially very thoughtful ones. And, I have a lot of people say to me, hey, why is it? How is this market so impervious? And, I just make one point talking to a lot of market participants, and I think a lot of smart people and a lot of smart commentators, over the last few weeks, there was this notion because of the blue wave and that there's just no reason for the markets to go down again. People couldn't find a reason for why the stock market should go down in 2021, given everything that's going on. And that's should be kind of alarming. But let's flip to the S&P 500. We have a one-year chart here, Guy. I drew a line from the prior all-time high in February before the market crashed during the throes of the pandemic. And I connected it to the September 2nd high, the November 9th vaccine high, and a level that the S&P 500 had kind of been banging around on either side in November and December. We obviously broke out above that early this year. And then I drew another support line that happens to kind of coincide with the September low, the November low pre-election, and now it's rising 200-day moving average. What does that range say to you about the S&P 500 for people looking to trade it?
Well, the most alarming thing about this chart is the fact that right now the S&P 500 is about 15% or so above its 200-day moving average. And it happens from time to time, but there's always a self-correcting mechanism that brings it back. And again, I think to Dan's point, for most people, 2021, they don't know, they can't see what that catalyst is. There is no catalyst for the market to go lower. This happens to be one of them, and I don't know what the match is going to be that's going to be thrown upon this this powder keg, but it's going to happen, and it's probably going to happen soon. And there are a number of things, not least of which this political situation, which really hasn't sorted itself out. And the next couple of weeks are going to be really interesting for a number of different reasons. But the thing that sticks out to me here, Dan, is the fact that, again, we're so significantly above the 200-day moving average. And we've been there now for quite a long period of time. You go back over history, and again, history does repeat. You'll see that these things correct, and they correct in a very precipitous fashion. And I know we begin to sound like a broken record, and I apologize for that. There are a number of things to like about the market, but we're trying to point out some of the warning signs that are out there. And I do think the warning signs far more outweigh some of the positive things that are going on.
Yeah, I think what you're saying, though, is we've been in this period for now nearing 3 months where it's just unfettered enthusiasm. And sooner or later, the chickens have to come home to roost. Let's move to the Nasdaq 100. We know that those top 5 or 6 names make up 50% of the weight of that index of 100 stocks. I have a chart here that I nicknamed. It's called the Hungry Alligator, Guy. If you can see this one, you see what's going on here. We had this kind of rise from the November lows. It was down, 11,000 to maybe 13,000 or so. We have that nice uptrend. It's held it like a boss, as the kids like to say. Look at that support range down at the September lows, and then those November lows, which were a higher low. But also you have that 200-day moving average moving up. You mentioned that the S&P 500, the moving average, is about 16% below where it was trading. This is almost 20%. This is getting a little overdone here. That's a pretty big range. If that alligator were to take a little bit of a bite, what's your take on the Nasdaq 100?
Well, first of all, I've never heard that term. So see, you learn something new every week on the macro setup. I appreciate that, Dan. It sounds very Brian Kelly-esque. But what I will say, and not to get very granular here in terms of individual stocks, but there are some things to be concerned about. Dan mentioned the predominant names in the Nasdaq 500. Just let me mention two. If you want to sort of play our home game, just take a look at the Apple chart. Apple topped out, I think, on September 2nd around 138 and change. Recently, it topped out right around those levels, 139. Classic potential for a double top, something to keep in mind. Obviously, you know all the things going around Facebook. Facebook's down about 15% from its all-time high on a tape that's been extraordinarily strong. They report earnings at the end of the month. Those earnings are going to be great. One of my concerns about Facebook granularly is the potential for it to fall under the auspices of ESG investing. And I'm not suggesting you go trade Facebook and Apple. My point is that plays into exactly this hungry alligator chart that Dan is showing. And again, 19% over the 200-day moving average. If you thought 15% is alarming, obviously 19% is more so.
Yeah, well, wait to get really alarmed right here. Look at the Russell 2000. Obviously, this is a small cap index here. We have a 5-year chart. It's really interesting that this one was really the hardest hit of all the major indices when you think about the balance sheets of the companies and where they're exposed to primarily. A lot of them very domestically, a lot of financials, a lot of energy. This was kind of ground zero for a lot of destruction during the pandemic, the quarantines, the shutdowns, all that sort of thing. So when the vaccines were coming, this sector really reacted. We have, this near parabolic move since the beginning of November. The Russell 2000 is up more than 30%. It's up 35% from its 200-day moving average. This would be one where, and Guy, we want to be optimistic about the vaccine rollout. It hasn't gone particularly well here in the United States. A lot of countries, as they did much better with the virus, are doing much better with the vaccine rollout. Hopefully that changes in the coming weeks, in the coming months. But what is your take on the straight line between here and getting 330 million Americans vaccinated and getting this economy opened? I think late last year, there was a lot of thought that we might be back up and running fully in the fall. That seems to be a bit of a stretch right now.
The Russell suggests it's going to be without any glitches whatsoever, the rollout. That's exactly what this chart is telling you. It also suggests that sometime in the back half of this year, it's not only going to be business as usual, but it's going to be better than it was in the end of 2019. I'm hard-pressed to believe that's true because I think a lot of things have fundamentally changed. But to answer your question, that's exactly what this move in the Russell suggests. And oh, by the way, I think the Russell is probably, again, if you thought 14% in the S&P 500 above the 200-day was crazy, if you thought 19% in the Nasdaq above this is now, Dan, 35%. And you illustrated this to me prior to the call, so you did the work on this, but 35% above the 200-day moving average, which is remarkable for a myriad of different reasons. The Russell is suggesting that the fall of 2021 is going to be the best period we've ever had in the history of this country, effectively, and I just don't see that happening. And oh, by the way, you have seen, we're going to talk about rates and the dollar, but this move up in interest rates, although some would suggest it's really bullish for a lot of things, I think it's anything but. And at a certain point, it's going to come home to roost, I think, in the broader markets and granularly in the Russell, as measured by the IWM or the RTY.
Yeah, let's hit the VIX here. We have a 2-year chart. We see that, for the better part of 2019, when the stock market was raging, and people were feeling really good about the economy. We had unemployment at 50-year lows, that sort of thing. We saw the VIX spend most of its time in the low teens, right? And so it started creeping up early last year in 2020, and then we saw just that massive explosion above 20, as high as 85 or so in the throes, really very near the lows of the market in mid-March or so. We've seen a series of lower highs, but we've seen that 20 level hold. And it just, to me, without getting too wonky here, that just tells you that investors are still kind of peppering here a little bit for protection. They don't feel we're out of the woods, probably for some of the reasons that you mentioned. We're not going to have a lot of visibility on when the economy gets back to those pre-pandemic levels. But right now, given the way the virus is raging and the mitigation attempts and the way the vaccine is rolling out and the political issues, it seems like there's enough to buy some downside protection with the VIX at the level of where it was prior to the crash in February and March.
Over the last couple of weeks, on moves that have been relatively modest to the downside, you've seen the VIX go from 20 to 30 now twice. And I would submit that just shows you what a hair trigger we are in terms of volatility and what potentially could happen. Each time, obviously, it's come back to the mean being this 21 or so level, but makes you wonder, what could happen next time there's a violent move in the market. Again, that move from 20 to 30 in both those days took place over the course of a couple hours in very modest moves. It's just something to consider going forward. I think my view on the VIX. Anytime it gets down to that 21 level or so, it typically signifies the short-term top of an equity move. I think that's happening again here now, Dan.
All right, cool. So let's hit rates. You started kind of, talking about it a little bit. We have a 5-year chart of the 10-year U.S. Treasury yield. We know that that's moved up from its lows at 50 bips at some point. I think that was in August. There was obviously a lower low intraday back in March, but this chart is pretty interesting. We broke that pretty steep downtrend from late 2018 when the 10-year U.S. Treasury yield was like 3.25 or so briefly. And it's just made a series of kind of lower lows. So we've broken that downtrend, but I think it's really important to look at where the technical resistance is back in 2016 prior to the election, when there was some serious growth fears, global growth, specifically in China. We saw yields all over the world going low. And at the time, the 2016 low at 1.4% was a max low, I think, from 2012, right? So where are we as far as rates? What is your take as it relates to equities? And then we have a 30-year chart I want to speak to, but I think this is the key. This one is the key, especially given what the Fed has said, but with the market getting ahead, we know the 210 spread is steepening. We know that's been good for banks, but what does this mean for equities and equity valuations in your mind?
Well, in my opinion, it's a foregone conclusion to a certain extent that we're going to test those lows back from 2016. So what was basically support becomes resistance, and it probably comes in the form of 1.45% or so in the 10-year. Number one. Number two, what does it mean to equities? Well, there are a lot of people would say that raising rates are suggestive of an economy that's improving, and that's bullish for equities. I understand that argument. I'm not one of those people. I think rates are going higher for the wrong reason. And then quickly, Dan, the volatility we're seeing in the bond market, again, harkens back to a certain extent what we saw in February and March of last year. Rates, just think about this, for example. 10-year yields have more than doubled over the course of the last 6.5, 7 months. That's extraordinary. But just look at the move over the last month or so, when rates have probably gone from 85 basis points to levels we're seeing now. Percentage-wise, that's a significant move that nobody seems to care about. I think the market's going to wake up one day and say, you know what, rates going higher in this magnitude is not bullish. And again, it all speaks to all the points we've made over the last 30 minutes or so. It's all part of this pastiche, or what's that thing that when people weave the blanket together?
A mosaic, a mosaic.
Appreciate that.
But I guess the other way to think about it is that it's a level of confidence that the economy is coming back and that the vaccine rollout is coming. That's the one thing I would say. So yes, I agree. A foregone conclusion. We get back to those 2016 lows. But those lows are really important. I want to put up a 30-year chart of the 10-year U.S. Treasury yield. And I think it's really interesting because you see that probably the most well-defined downtrend in the biggest asset on the planet, right? When you think of U.S. Treasuries and the yield on that. And I think it's really interesting. Look at that first red circle that I have. The market topped out in early 2000 when the 10-year U.S. Treasury yield was above 6%. And then in 2007, the stock market topped out when the U.S. 10-year Treasury yield was above 5%. And then that third circle I have on the right there is the 10-year U.S. Treasury yield topping out at 3.25 back in late 2018, and the stock market topped out then. Now it went down 20% in a straight line, and the Fed had to get a little jiggy, as they would say, with their forward commentary and that sort of thing, and basically saying rates should go to zero. And what have they done? They went to zero for all intents and purposes. So I look at that 2012, 2016, and then the break, let's call it around 1.5%, is really significant. And I think something will happen with equities if we breach that in a meaningful way. And when you look at that downtrend, you'd say to yourself, if you're bullish on yields, that you might see yourself getting back towards 2.75, 3%. What does that mean for equities? What does it mean for the economy at that point?
Well, you've outlined it. Of all the important charts you've brought to us today, I think this is the most important because it speaks to exactly that. If you want to understand why equity markets top out in the short term, just look at this chart. And I think, Dan, the October 2018 level, which is the final circle on this chart, was, if you recall, when Jerome Powell came out, and again, I'm paraphrasing, but basically said, we're sort of on cruise control to normalize rates, and we're going to reduce our balance sheet. And from October of 2018 to early December, the market went down exactly 19.9%, pretty much in a straight line, until he was forced to do a complete about face. And then you've obviously seen what's happened since. Rates are going higher. I think that, again, talking about foregone conclusions, that genie seems to be out of the bottle. What's fascinating about this chart is you can still be in a 30-year downtrend, a significant downtrend, and still trade up to almost probably close to 3% in terms of the 10-year yield. So just think about that. There's so much room to go, and you can still have sort of a bullish thesis in terms of bonds, or bearish thesis in terms of yields, however you want to discuss that, with yields getting back up to close to probably close to 3%. It's fascinating, and I think this chart speaks to exactly that. Am I concerned? Yes. Have my concerns been unwarranted? 100%. But this is something that I think bears watching as well, Dan.
Guy, you say that all the time. You say it on Fast Money. You say it when you and I do a lot of content like this for folks like Nadex and stuff. And listen, we're not your hedge fund manager. We're not your broker. We're not your this or that or whatever. We're here to kind of call balls and strikes, right? And people are wrong all the time for a whole host of reasons. But I think if you're an investor or you're a trader, I think you want to be aware of both sides of the coin. And that's what we're trying to do here. All right, we have a couple minutes left, Guy. Let's talk about one. You've been all over the dollar move. This has been, you don't like to give yourself too many accolades. You've been calling, lower lows in the dollar since March. And it's a trade that's worked out really well. I do understand that, especially as we got below 90 in the Dixie on that 1 year chart, we broke that 92 level. That was a September low. You've not been as pounding the table on the near term about it going straight back to, let's say, the 5-year lows. But this chart's really interesting. We're seeing a little bit of a bounce. Maybe that, makes sense in what we're seeing as far as in the bond market, that sort of thing. What's your take right here? Are you getting ready to reload on this thing? And do you think we see 92 in the Dixie in the next few weeks?
Yeah, if you're trading, we talk about Nadex, binary options, knockouts, and call spreads. I mean, I think the dollar sets up for, if you're looking for a knockout trade, this is it. Do I think we get back to 92? I don't, but given the chart that Dan has drawn and the trend line, this is suggestive that maybe you do see that bounce back to 92 in a still very, a 7, 8, 9 month downtrend. Look, I think the dollar is destined to be significantly lower this year. I think there are a lot of people that agree with me. I think what we're seeing now is a bit of a relief rally. Maybe that runoff election in Georgia marked the short-term bottom for the dollar. It could be. But I do think, we're going to have this conversation a month from now, and we're going to be talking about this DXY, which is now north of 90. I think we're going to be talking about it with an 87 handle. In the meantime, you could get close to 92. So, trade accordingly. But in my opinion, everything sets up for a weaker dollar. That is consensus, but sometimes what consensus is right, Dan.
Yeah, let's just go quickly to the 5-year chart, and you look at that 2018 low. That's really the only line to draw here. That would be your near-term target, and you might take another view depending upon what's going on in the world right there. All right, Guy, you've also been really great on gold all year long. Obviously, the last couple of months, it's been kind of odd, and it's also corresponded with that huge move in Bitcoin that we started the show talking about. We have a 1-year chart of gold here. Let's talk about this. That late November low happened to correspond with a breakout from June, July. We also saw that pretty well-defined downtrend from the early August highs. We broke that downtrend briefly a couple weeks ago, but it's since the Bitcoin surge, over the last month or so, this thing has really lost a lot of its mojo. What's your trade on gold here? How are you thinking about it for the balance of 2021?
Yeah, I appreciate that. So it's an incredible chart. We've had this chart up a couple times, and if you remember, probably the last time we came on, when that broke that downtrend line, I said I'm pretty confident that I said this sets us up for gold to go and take a look at that August 7th high, which I think is around 2075, 2080 or so. Yeah. and it seemed to be spot on. But we, unfortunately for the gold bulls, we basically topped out just at the same high we'd made back in October. Maybe in retrospect, that's right. And obviously now we've broken back through it. I will, if I'm a dollar bear, which I am, I will remain a gold bull. This move down took me by surprise. But again, I just think it's setting up again. If we go through that downtrend line, and that probably comes in either side of 1900, I don't think it stops this time. So I apologize, for not seeing that, short-term double top around the October highs. But I think the next time through that downtrend line will set us up for a test of that August high, which again was 2075 to 2080.
Guy, no apologies necessary here on the macro setup. We call them like we see them, just as we said here, no crystal balls. Let's go to the 10-year chart and let's end on this one for gold. And I just bring this up is that, this thing has had a heck of a run over the last 2 years, and you've been all over it. Literally, you've been all over it from 1200. Okay. I'll just take the other side of this thing and just say, for whatever reason, there's a lot of these arguments, a lot of people who are Bitcoin bulls just saying they're thinking about the percentage of Bitcoin's market cap relative to gold and the institutional adoption and the central bank focus on it and all that sort of stuff. Maybe that was it. I'm just saying, if you go back and look at that 2011 high, and then you look at that 2012 high, I mean, we saw, a precipitous drop, nearly a 50% drop in a 5-6 year period. And, you're looking at this thing still in a pretty decent downtrend from those August highs. So this is a chart I think is just really worth kind of focusing on a little bit. I'd say 1800 is a big level. That's probably for longer term investors where you might want to set a stop. But I know there's a lot of people who say always own 2-3% of your portfolio in gold, but just maybe part of that is swapping out of gold into Bitcoin. I'm not advocating that. I'm just saying that might be what's going on here.
Yeah, I think that's exactly what's going on. It's going to be fascinating to see over the next couple of weeks if Bitcoin gets back to that 20,000 level that we talked about and outlined. What happens to gold? Does gold make the next leg higher, or does gold somehow get caught up in that maelstrom? I think gold takes the next leg higher, but that's what makes markets, as they say. Anyway, Dan, this has been extraordinarily informative for me. I find myself not only a participant in these conversations, but a viewer as well. And that's thanks to you. But I also want to thank our presenting sponsor, Nadex, the leading U.S. exchange for binary options. Get ready, Dan. Call spreads and
knockouts.
Damn straight. Thanks, Dan.
Thanks, guys.